Hello and welcome to Be the Boss of Your Money. I'm Mitch Goldberg. You're watching my live stream every Monday through Thursday at 4:30 p.m. Eastern Standard Time. Today, the market rebounds. Are we seeing all of the wrong signs that we are in a rally that people who know the economy are hating right now? We talk about investing, personal finance, what's taking place on Wall Street, how it affects you, and what could be your next best move. These are the things you talk about on Be the Boss of Your Money. If you have any questions about what we're talking about now or anything to do with investing, borrowing, personal finance, please hit me up in the comments. I love hearing from you. If you're watching this in the replay, welcome to you as well. I would love to hear from you, so don't hesitate to ask me your questions in the comments, and I will certainly see those as well. We're going to roll a quick introduction. We've got a lot to cover, and then we're going to have some fun with this. Here we go. Thank you for joining me. If you're just joining me now, we're just getting started. I'm Mitch Goldberg. You're watching Be the Boss of Your Money. Today's topic, of course, we go through the market update, but what's the deal with Goldman Sachs, Morgan Stanley, BlackRock, Wells Fargo, all consistently going negative across the board on the stock market, while the stock market hit a new record high today. The S&P 500 hit a new all-time high today. So what's going on? This is something we've been talking about for a while. There's something that lurks beneath the surface that we can't skip it. We can't let it go. Just because we don't see it right in front of us, it's lurking right under the surface, and it could jump out and bite us in the you-know-what. So let's do a quick share screen. By the way, let me know where you're watching from. Give me one of these. Let me know where maybe a heart, and I'll see your name. I love that. And, questions in the comments. But we're going to do a quick share screen, and I'll just pop myself in here. Okay. First, let's take a look at how the overall U.S. markets did today. I'm going to make this a little bit bigger so that you could see it. I'll switch to camera 2. That's better. That's better. Okay. Can you see that on your smartphone? Okay. So Dow up 104, recapturing about half of its loss from yesterday. NASDAQ barely up, but an up day is an up day. It was up yesterday. It continues to go up today. S&P 500 up about 15 points, new record high. Gold moving up a little bit, but that's a mixed signal. Oil backing off a little bit. But this is the biggest story of the day, I think, is the 10-year Treasury. It was in the 1.29, 1.28 area. Now it closed at 1.32%, but still the yield continues to move lower. That is really scaring the heck out of a lot of market participants. The VIX, though, continues to go down. Look, all I'm saying, wait a minute. Can you even see the screen? Let me pop myself in here like this. There we go. That's better. Doesn't matter if you saw what I'm talking about until now anyway. So let me just say this. So the VIX, I'll highlight that here. That is at 16.2. It's so odd that the VIX is going, well, the stock market went up a little, so the VIX you'd expect would go down a little bit. But the 10-year Treasury keeps going lower. And why would gold go up and oil down? There's just a lot of mixed signals. If you're worried about inflation, shouldn't oil go up and gold, but gold went up, but oil went down. And I just think there's a lot of cross currents, a lot of funky movement going around, a lot of investments, a lot of indicators that are typically correlated are breaking down a little bit in terms of their correlations. We'll just run it down here to the Russell 2000. That was down. Russell 2000 was down almost 1%, so down 0.95%. And that keeps going down. It goes down more than the averages when they all go down. But in a day when the major averages were up, the Russell 2000 was down. So that tells you that investors are a little bit worried about the economy because small cap stocks are more sensitive to the strength of the economy. And that jives with the 10-year treasury yield going down a little bit too. But it does not jive with gold going up, but it does jive with energy going down a little bit. So some things are jiving. Some things are, I don't know, what's the opposite of jiving that rhymes? I can't think of anything, but it's not all working out together. And let's just take a look at some of the stocks here. Apple continues to move up, just move right around highs. Let's just take a quick look at Apple. Okay, didn't quite hit its all-time high, but it is getting darn close. Anyway, Apple's trading around its high. Microsoft was up, trading right near its high. Amazon today did set a new high. It was up a lot yesterday. It's up today almost. It's an all-time high. Not too far away from that $4,000 per share mark. It would not be the most high price. It would not be the highest price stock though. That would go to Berkshire Hathaway, which is well over $100,000 per share. Google right around its high. Facebook is backed off a drop, but still trading not far from its high. And Nvidia barely dropped from its all-time high. And so the large cap tech stocks continue to make moves up. Let's take a look at the sectors on the day. Let's take a look at the sector watch list. Where are you? Sector ETFs. I'm giving you headaches scrolling up and down. Building materials had a good day. Industrials had a good day. Utilities had a good day. Healthcare, technology had a good day. What did not have a good day? Communications, energy, consumer discretionary. Energy being down 1.63%. Ordinarily, I would say that's the XLE down here. And XLE down over here, okay? Ordinarily, I would say that's a tough day for energy. That's the ETF that tracks a basket of large cap energy stocks, oil service related stocks. But it's been up so much lately that to see it back off a little bit is not really a big surprise. I'm not saying it's not a concern, but it just seems all of a sudden everybody's worried about the economy, and that's where some cross currents are coming in. So let's go back to screen one. I'm going to put this all together for you, okay? This is what has investors worried. If the leadership that drove the S&P 500 to an all-time high today, the leadership. So here's the thing that has investors on edge. And this is one of the reasons why you're seeing the investment strategists at some of the larger investment financial firms coming in with a negative forecast for stocks over the near term. It's because, and I'm going to put this together for you, because we've been talking about this for a while on the show about how the rotation into the inflation trade, the cyclical stocks, has peaked. And this is why we've been talking about rebalancing, taking some money off the table. This is one of the reasons why I've been selling some of these materials and industrial, economically sensitive stocks, taking some profits on bank stocks with my own clientele. This is nothing new. This is what we've been talking about here on the show, and move some money back into some of these work from home, stay at home stocks that tank. Not all of it, building up a little bit of a cash reserve. In some cases, in some clients' accounts, a bigger cash reserve. The reason being is that a lot of accounts, this is all over the place, have gotten above and beyond their allocation toward stocks. And while it's great making all that money, the risk control is what we need to worry about. And that's why you have to rebalance and shave that stock holding, that stock allocation. This is the international sign language for shaving down an asset allocation, shaving down that stock allocation, and moving that money back into where it should be, according to a client's asset allocation model, their investment policy statement, which you should have one if you don't, raising that bond/cash portion of the portfolio. And certainly, as you have less time to needing some of your money for financial obligations, that money should be moved out of risky assets like stocks and placed into more stable assets like money market savings accounts, CDs, and other kinds of cash equivalents. Okay, so what we're seeing is something we don't like. And I know what you're saying. You're like, how could you not like new highs in the stock market? But what we're seeing right now is a issue where the stocks that led the stocks that led the rally during the pandemic while the economy fell apart, those stocks are rallying again. And just a quick reminder, the reason the stock market was able to do so well during the pandemic, during the shutdown, is because the stock market measures the performance of the largest publicly traded companies as measured by the S&P 500 index. Okay. So just have to say you can't invest directly into an index, but you could invest into a security that tracks or mimics an index. There's a difference. But the S&P 500 is dominated by some large cap tech stocks like Facebook, like Amazon, like Nvidia, like Netflix, like Microsoft, like Alphabet, which is Google. Okay, Alphabet. Google changed your name to Alphabet if you didn't know. And some other super large cap stocks, Microsoft, if I didn't say. So these stocks do well when the economy is perceived to be getting weaker. And that is because these companies, their earnings and revenues, their growth is steady regardless of the economic cycles. If the economy really slows down, though, these companies could do even better. Okay. Plus, they're big companies, and the bigger a company is, the more of an impact it has in the S&P 500. So when the biggest companies are doing well, they drag the index with them. They pull it with them, I should say. And that's why you're seeing the S&P 500 hit a new record, because of these tech stocks. It's not hitting a record, or it's not participating in the record highs, though, are a lot of the economically sensitive stocks, like bank stocks, for example, which have been getting hit pretty hard lately. And that's because long-term interest rates are coming down, and the spread between short-term rates and long-term rates has narrowed. That means the yield curve is flattening. That's just jargon for saying that the difference between short-term rates, which are like about 0%, and long-term rates as measured by the 10-year Treasury, which is about 1.4%, when that narrows, it's not good for bank stocks. It's also an indication of less confidence in the economy, and it's an indication that investors see lower inflation, not higher inflation. And while they may not be the investors who are really piling into bonds, they might not be the smartest in the world, let's say, because I know you're thinking, oh, there's inflation everywhere. How could they not see inflation? But they are the biggest, and it's the big money that moves the market. So we're seeing a compression in yields. We're seeing long-term rates go down. We're seeing work from home, stay at home, secular growth tech stocks leading the market higher. This is from the playbook that we saw a year ago when we were up to our eyeballs in the economic shutdown due to the pandemic. And we're seeing that now. It's not really what we want to be seeing at the stage of recovery. So we're getting signals that tell us, A, that the recovery is at its peak of power, peak recovery. Something we've talked about yesterday. In fact, we spoke in the last few weeks, we've been talking about this. We've seen peak stimulus. Once we finally get this bipartisan infrastructure deal through for about $1 trillion, that may be it. Like, that's it for the big stimulus programs and the Federal Reserve, which continues to buy bonds every month and keep rates at zero. they've indicated that they are pretty much getting to the end of their stimulus programs. So we've seen already peak stimulus in all ways, including spending, fiscal, and monetary. That's what the Federal Reserve does by keeping rates low. If we've seen peak, that is not confidence inspiring for PE ratios, price to earnings multiples, moving higher. That means valuations could, come down. In a lot of cases, they are coming down in a lot of the stocks that you want to see go up, like energy stocks and financials. And that's a bit of a problem. I want to show you something else which kind of jives with this. I'm using the jiving word a little too much, maybe, but let's take a look at the reopening stocks. How do you like that? When I look for reopening stocks, I'm going to switch back to camera 2. You know what? It looks like when I do the pop myself into the picture-in-picture, it's going to camera 1. All right, just another thing to work on. All right, but aptly enough, I have my reopening stock list called reopening stocks, but Marriott was down, Planet Fitness was down, Delta Airlines, Southwest Airlines, UAL, Royal Caribbean, American Airlines, Norwegian Cruise, Carnival, Cinemark Holdings. You want to see these stocks going up if the economy is getting better. And, stocks are a forecasting mechanism. You put it all together, it looks like the signals that we're getting are telling us that we're already looking past the peak of the economy and looking at the slowdown coming up in the next 6 to 12 months and possibly even a recession. Now, that's the moment-to-moment view, and I'm not trying to scare you or be all doom and gloom. But what I am saying is that stocks are a 6 to 12-month forward-looking indicator, or at least that's what they're considered by a lot of people. And that's what they're telling you. That's the signal now. Now, if interest rates turn around and start going back up again, I think we'll take that off the table. But I think a lot of people are shocked by the interest rates coming down the way they are in the 10-year Treasury. So I want to show you the meme stocks. Let's see. And my meme stocks list is actually called meme stocks, so it's pretty easy to find. But look at this. AMC down almost 10%. GameStop down 4.5%. Bed Bath & Beyond down almost 5%. Koss, Clover, Wendy's. If you see on the right here, this line, it's green and red. The right side, the furthest right side, is simply the high. The left side is the low, and where the little arrow is, that tells you how far a stock has moved between its high and low. These stocks were all recently at highs. Look how all that red. Look how much stocks have moved. This arrow has moved from all the way to the right to the middle. GameStop, more than half. Clover was just $28. Everybody's getting excited. You see, I told you, Clover. And it's back down to single digits. Wendy's was 29, back down to 22. Bed Bath & Beyond. I mean, Bed Bath & Beyond was up to $54. What the heck was it doing at 54? There were other companies that got caught up in this too. But these are the ones that most people follow. These are the ones that you see, like AMC to the moon, Diamond Hands. All right, so let's take a look at the most important thing of the day. Let's get to the heart of the matter, and then we're going to wrap things up. Don't you guys have any questions? I mean, come on already. Let me know where you're watching from. Send me a smooch emoji. All right. Pop myself back in here. Multiple market strategists are getting worried and believe all the good news could be priced in. Now, this is including Morgan Stanley, Goldman Sachs, Citigroup, amongst others, who said that despite a booming economy with strong earnings, there's a complacency in the market, in particular with inflation. This should be stuck on that picture, but I see a comment out there. Let's see. Josh is out there. No questions. You're just, look at that. No questions. You're just too good at this. That is so, that that is so you. It's so funny, Josh. That is so your. I know you, so to me that's very funny. And Phil is out there coming to us from Vero Beach. Vero Beach right now sounds absolutely lovely. Phil, I may be in Florida late September. I'll be looking you up. If I am, I'll know a little bit more about this over the next week or so. All right. So this is just breaking news, hot off the press. Okay. So the bottom line is the U.S. economy is booming, but Morgan Stanley strategist Mike Wilson, what isn't clear anymore is what price will this growth accrue. So you're not actually seeing what I'm seeing, but let me see if I could put this back. All right. All right, we're just going to skip that for a moment. But what they're saying is this. Inflation is going up. That means the cost of producers for input goods is going up, which means it squeezes their profit margins if they can't raise prices to consumers and businesses, to the end users. So that's one worry. That's for now. But the Fed is saying that we see a lot of the inflation as being transitory, supply chain disruptions, pent up demand. That's why restaurants are so crowded today. You can't get a reservation at a decent restaurant today. You can't buy a new car today because none of the dealers have cars, unless maybe you want to get a car that's mustard yellow or avocado green. And but then what they're saying is, what's unsettling is that the wrong stocks are leading the market, and the 10-year treasury yield keeps getting crushed. Yesterday, Wells Fargo put out a note. Their chief strategist, I forget his name, but we spoke about that yesterday. His year-end target, it's about 10% lower than where stocks went out today on the close. But all these strategists have targets for year-end S&P 500 below where we are now. You know, I take this with a grain of salt. I don't make changes to my portfolio or my clients' portfolios at all based on headlines. The decisions, the changes are based on their own personal finance, their own time horizon. Now, I do have a number of clients who are not as much into the process and more into the returns, okay, and just going for the returns. So there are cases where I will move in and out of stocks or change, do my own market timing for these clients' portfolios. But that is not really the majority. That's kind of the minority of clients. But basically, as you get closer to your goals, your personal finance, those are the things that should dictate your buys and sells, not just because strategists say we could go down and the market could close this year lower. If the market closes lower than where we are now, what does it have to do with anything 5, 10, and 15 years from now? I'll give you the answer. Nothing, unless you're the one who sells out now because you're worried or upset, panicking. I'm not saying you who's watching this is like that, but other people, okay, people in general. And then what happens is market goes back up, market makes new highs, albeit different stocks leading to the new highs in every bull market, and then you miss out. Now, if you're an individual stock investor, I think it makes the job a little harder, but that's why it's important to take some off stocks as they go up as well. All right, so that's my story. I'm sticking to it. Phil, I see you out there. Glad to have you. I know, because you were so hospitable, and we're good friends, and I can't wait to see your new place and visit with you and Deborah. That would just be so awesome. All right, so that's it today. That's why the big firms are concerned. They're not throwing in the towel. If the market goes down, all right, it goes down. We've got walking around money in our portfolios, so we are ready to pounce. But for me to pounce right now on a stock, seeing a stock go from $200 a share to $195 a share is not exactly inspiring to me to go pounce. We really need to see a big dip. And It looks like the market could be getting set up for one, but that doesn't mean we make drastic changes to portfolios, financial plans, etc. Thank you so much for watching, and I will be back tomorrow with more Be the Boss of Your Money.